It is a pivotal week for markets. I'm joined by John Manley, Chief Equity Strategist at Wells Fargo Funds. John, good to see you here.
Great to be here.
Well, let's talk about the start to this week, and that is some very serious, renewed worries about Greece, and it looks like things are not going well at all.
No, they're not. I mean, the Greeks seem to be threatening to kill the hostage, not realizing they're the hostage. And I think it will work out. I think they'll come to something. I also can't help but believe the Germans haven't planned for this. The Germans knew this was coming 5 years ago. And so I think there's going to be disruptions if Greece stays with their pattern. But even if there are, I think they're going to be somewhat contained.
But what if there is actually a default? We're already seeing markets respond with negativity selling across the board. Is that going to price in a default? Should it happen? Worst case scenario?
Nothing's ever priced in because there's always the hope. Wall Street tends to be a very optimistic place by nature. But I do tend to think that there are plans, that the debt is in hands where a default would not be fatal. It's not going to be fun. The market's not going to go up that day, and it may not go up for a while after that. But I don't think it's going to go down an awful lot. And I think at some point in time, it's better to have been through it and have it done.
But at this point, aren't the markets looking for a reason to sell off? There's been some concern about overheating in stocks in the U.S.
You know, I don't see it. I mean, I understand the thought. I mean, they're very thoughtful people and they're very bright people who are saying these things. You know, I don't worry about the 10% correction because there have been 4 to 8% corrections. I don't sense investor enthusiasm. I think we've gone through a period of time when the Fed is sort of like a life jacket for the market. It's not their intent to be a life jacket, but as they push money towards the economy, it tends to flow through the through the capital markets and make them move higher. So I think that helps us get through it. I think at some point in time, what's right in front of us right now with Greece will be in the rearview mirror. And when that happens, a week, a month, I don't think it's going to be much more than that. I think it'll be better to have had it done.
John, at this point, even if we get a 10% correction, do you change the way you view the market or change your approach to a portfolio? Do you get more defensive, for instance, until this is settled?
I'm going to look at investor sentiment. I'm going to look at what the Fed's doing. I think the Fed will raise interest rates sometime in the not too distant future.
But not this week.
Well, not this week, and also they'll only do it when it's not tightening. I think people have been using the term tightening and higher rates as the same thing. They're not. They're different things. The tightening is when the Fed wants to slow down the economy and they pull money out of the economy in the capital markets. They're not going to be there for a long time.
John, in terms of what you like in the market now broadly, what sectors seem poised to you to perhaps outperform the market for the rest of the year?
Well, I like financials. I never thought I'd say that after having gone through what I went through in the last decade. But I think if the Fed does start to edge rates higher and the economy is getting better and they're not tightening, that's actually a pretty good environment for financial stocks. I like technology. I don't think the upgrade cycle's over. I think the pressure that we hear about coming for wages, I think they'll use technology to try and make the people whose wages go higher even more productive.
Let me pin down, when you say you like technology, that's a big, broad area. Where specifically in technology?
Well, I can't get too specific, but I will say I think it's the big old companies, the ones that business-to-business technology. I'm too old to really understand all the toys. They only work 50% of the time for me. But business-to-business technology makes corporations more efficient. The way I look at it is, in the last 10 years, corporations have used technology to make their employees much more efficient, and they kept all the difference for themselves. Now they're going to have to give some of that away at some point in time. But I still think I don't think wages will go up faster than productivity.
Any thoughts on energy?
I'm a buyer. I like the big old Rockefeller companies. I think the integrated oils are a pretty good place to be. I think people underestimated the intelligence of the Saudis. I think people thought the Saudis thought that they could get rid of fracking. They can't. They know that. They can get rid of the frackers, but fracking will be with us. I think all they wanted to do was slow down exploration a little bit. And where we are in oil prices right now, I think, does that. I also think Americans, seniors like myself, at some point in time will have to retire in high-quality stocks. And when energy's sold off, they just put a whole section of that on sale.
Anything that looks a little bit too risky or something that you're not so favorable of in the next couple of months?
It's not that I dislike anything. The more bond-like something is, the more fixed the return. I think at some point in time rates are going to go up. They're extraordinarily low right now. I don't think that'll be a surprise when it happens, but I'd rather own companies that were connected to the economy. I think rates will go up, but only when the economy is getting better. So I want something to offset that higher rate scenario.
John Manley, great to talk to you. Thanks. I'm Rhonda Schaffler for The Street.